A typical day transforms into a barrage of headlines, market prices, and urgent forecasts that are hard to overlook. This noise encourages investors to view short-term market fluctuations as indicators, instead of recognizing ownership as the primary focus. This shift occurs because attention instinctively gravitates toward dramatic events, and the market delivers new drama every hour with fresh updates. When drama dominates the decision-making process, reactions become impulsive, and strategies shift each time fear or excitement flares. The outcome is a cycle of buying after gains, selling after losses, and incurring unnecessary expenses throughout the journey. Over time, these costs and errors compound, widening the disconnect between market performance and individual results. A person who checks prices before work, during lunch, and right before bed may feel informed, yet they often become less consistent in their actions. In contrast, someone who owns a broad market portfolio and ignores the daily fluctuations can achieve returns with significantly less stress. This video explains why broad ownership and minimal costs are crucial, and how patience can protect your investment strategy. This video draws inspiration from The Little Book of Common Sense Investing by John Bogle, so subscribe for more clear investment strategies. The key idea is to own a piece of the entire market instead of chasing a handful of winners. An index fund accomplishes this by comprising a diverse set of stocks that mirror overall market performance. By distributing ownership across many companies, performance relies more on the economy than on any single unforeseen event. This structure eliminates the pressure of selecting the right fund manager or predicting which sector will lead next. In a booming sector, a narrowly focused fund may skyrocket, only to plummet when market leadership changes. A total market fund mitigates that risk by diversifying across multiple industries, making results less reliant on a single trend. Instead of placing bets on specific ideas, this method embraces market returns while concentrating on preserving them. A straightforward next step is to choose a total market index fund and write down your reasons for staying committed. Then evaluate its ongoing fees and turnover against other options and pledge to hold it through market cycles. Long-term stock returns come from two primary sources: business performance and shifts in investor valuation. The first source includes dividends and earnings growth, which typically align with the broader economy. The second source involves changes in price levels, particularly variations in the price-to-earnings ratio. When investor enthusiasm rises, prices can spike beyond actual business progress, resulting in a temporary boost in returns. Conversely, when enthusiasm wanes, prices can decline, leading to negative returns even if businesses continue to thrive. This fluctuation is why short-term results can appear extraordinary or dreadful without altering the long-term advantages of ownership. A portfolio based on price forecasts tends to be fragile because predictions can change far quicker than underlying fundamentals. On the other hand, a portfolio grounded in broad ownership depends on market competition to identify winners and losers. By embracing this approach, you position yourself for more resilient and consistent investment outcomes. The practical lesson emphasizes focusing on controllable factors such as costs, diversification, and riding through market cycles. With this focus, short-term price fluctuations become mere background noise instead of directives for action. While costs may seem minor in a single year, they become significant when compounded over decades. The basic math shows that market return minus costs determines the net return that investors ultimately keep. Management fees, trading costs, sales charges, and taxes all diminish what is left for shareholders. High turnover in portfolios leads to increased transactions, which generate additional costs without enhancing overall market returns. Even a small annual cost difference can create a considerable gap in ending wealth throughout a working lifetime. This is why seeking out a brilliant manager often results in disappointment. Any extra return must surpass additional costs. A low-cost index fund starts off ahead by reducing the drag that active strategies need to overcome. This strategy treats cost control as a lasting advantage, proving effective in both favourable and unfavourable market conditions. A practical next step is to calculate total fund costs and select the broadest option with the lowest ongoing expenses. If minimising hidden costs and retaining more returns sounds beneficial, consider subscribing for step-by-step investing guidance. Before accounting for costs, active managers collectively own the same market portfolio shared by all investors. This mechanism is straightforward. Every trade matches a buyer with a seller holding identical securities. Consequently, the group cannot outperform itself collectively, as gains and losses neutralize across participants. Once fees and trading costs are deducted, this collective underperforms the market due to that drag. A manager may appear brilliant for a few years, but their shine can fade once luck shifts and leadership changes. Investors who buy after the hype often end up with average returns that are reduced by higher costs and additional taxes. This is why broad, low-cost ownership stands as a sensible default when arithmetic governs outcomes. Indexing captures the market's gross return and avoids paying for a contest that cannot financially reward all participants. A practical next move is to compare the total cost and turnover of an active fund against a broad index alternative. If the odds do not support the difference, opt for the simpler choice and remain consistent over the years. A solid investment plan depends less on clever maneuvers and more on maintaining disciplined consistency through various market cycles. The toughest challenge is staying invested when alarming headlines signal danger and price declines feel like personal failures. Selling in a panic locks in losses, while buying during periods of euphoria locks in high prices and positions us for low future returns. Pursuing whichever fund has recently excelled typically results in buying high and selling low in repeated cycles. The better strategy is to hold a broad index, rebalance from time to time, and disregard daily scorekeeping. Choosing to do nothing most of the time is not laziness. It is a deliberate decision to avoid detrimental actions. A low-cost structure encourages a focus on long-term growth, diminishing the need for constant justification of fees through frequent changes. With time on your side, patience allows for compounding to flourish without disruptions from unnecessary trades. The real advantage lies in temperament, as the market tends to reward time invested more than trying to time the market. Committing to your strategy is a practice rooted in self-discipline, rather than reliance on predictions. The key shift is prioritizing ownership and managing costs rather than getting caught up in forecasts and making frequent adjustments. Broad index funds align your portfolio with the overall progress of businesses, reducing reliance on speculation. A clear understanding of speculative market fluctuations helps maintain realistic expectations, particularly when prices move sharply without reflecting fundamentals. Simple arithmetic brings attention to the disparity between gross returns and what you actually keep after all costs. The collective dynamics of active trading clarify why sustained outperformance is rare, especially when accounting for expenses. A well-defined plan focuses on selecting an allocation, minimizing turnover, and remaining invested throughout market cycles. The objective isn't about constant exhilaration, it's about significantly increasing your chances of reaching long-term goals while making fewer errors. Starting with smaller investments and remaining consistent proves that time and low cost can be more effective than sheer cleverness. If the process seems straightforward, that's intentional. Simplicity is key to maintaining discipline over time. If a calm, market-wide approach brings you peace, consider subscribing to refine a simple and trustworthy system for your investments.